So when we look at price action, if you strip it back to retail logic for a moment, traders are usually trying to buy support and trying to short resistance. And my agenda has always been trying to get to the root cause or the underpinnings of the marketplace and look for like draws on liquidity, areas that price should support or resist, and the logic behind it should be sound, not some randomly selected support or resistance level, be it horizontal or diagonal trend support or resistance, which I'm not a fan of. But if you look at this example here, each one of these sets of horizontal lines is an individual new week opening gap. You can see how price gravitates towards them. It may pass through them like a hot knife through butter, or reach them, consolidate around inside of them, and then expand to the next one. I want to talk a little bit about opening prices. Now, openings are not random price events. It means that wherever the first opening trade is, the first tick of the marketplace, when the new week opens at 6 p.m. New York local time, that price is absolutely not random. And the proof of that is to watch how price respects it throughout the week and in the future, in weeks and months ahead in the future. So I want you to think about the importance of knowing what the opening price is on Sunday. And I've taught in other lectures how it's important to take that Sunday opening price and extend it through the entirety of the current trading week that you're about to start or what you're presently trading in. But the entire new week opening gap, high and low, that range will be projected in the future for many weeks. So you can see the relationship of where that opening price is here on March 5th, 2023 at 6 p.m. That opening price is what I'm annotating. So to find the opposite end of the new week opening gap, we can see where price was on the previous Friday. So we're going to have to look at the difference between these two price points here to come up with the new week opening gap for March 5th, 2023. Much in the same vein that opening prices are not random price events, closing prices are not random. Now, it seems like buying and selling pressure, if you read all the books and listen to other people talk about it, the talking heads in this industry that are supposedly technical analysts, they'll tell you that price is random and no one can predict the price. No one can know what price is going to do. And many times my students have watched and observed how price really respects these new week opening gaps, not just the very day that they form or that particular week, but weeks and months in the future. So let's take a closer look at that particular Friday, which is March 3rd, 2023. That's the last closing price before the session ends on that Friday. So now we have two price points here. So we have the opening price on March 5th, which is a Sunday. You can see that over here. And then annotating the Friday closing price. Between those two price points, that's what the new week opening gap is. So an ICT new week opening gap is this very separation between the two price points. Now, because Friday closing price of that March 3rd, 2023 is above where we opened on the subsequent Sunday opening price, that means that Friday's closing price is the new week opening gap for that gap. And then the opening price on Sunday is the low of this particular gap. If the roles were reversed, if we opened above wherever we closed on Friday, then obviously these labels would be diametrically opposed. Extending the new week opening gap into the future price action. So you can see here using that March 3rd and March 5th new week opening gap. Let's take a closer look here. Here's that same gap, and we've extended it through into the week. You can see how price has treated it as resistance, pulled away, rallied through, came back down in. Notice that it's two passes. There's a separation between these two price points. So buy side was offered here. What's lacking? sell side. So movement on the downside. There it is. So now price tries to move away, runs buy side, trades below the short-term low here. And notice how it's gravitating back and forth around this new week opening gap, but still respecting it. See all the candles here individually? These are 5-minute candles, by the way. Market trades up, finds some support here, and then springs higher above for buy side, trades all the way up to a old new week opening gap, trades to that new week opening gap low. I'll leave this price levels here for you to go and do your homework and find out what that new week opening gap is anchored to. Hits resistance on that new week opening gap low, trades down, goes right back over top of the, at this time in the price action that is being shown, this is and will be considered the current, not the time of this recording, but the current in this fractal in terms of this chart, how much data is being shown. These two lines here is that week in history's current new week opening gap. It returns all the way back down to it. So see how price treats these new week opening gaps specifically as magnets. Okay, it creates this willingness to want to go right back to them. And it's a fair value function in price delivery. The gap is not a random event. It's engineered, it's designed. And then smart money uses these old reference points throughout the future week of trading, the future month of trading, and for several months in the future. So the market finds some support here, rallies away, and consolidates around and draws right back down into that new week opening gap once more. Trending signatures with the new week opening gap. So if you think about when a market is indicating that it really wants to run away and trend, there's lots of things I've read over 30 years about what makes a market want to trend and consolidate. And one of the things that I've learned is with this new week opening gap, you can see here, this is that same week extended forward. And then look at what we've done here. We extend the amount of time inside that new week opening gap, and then it aggressively runs lower. Whenever there's a sudden move away like this, that indicates that we are entering a trending market. Notice how we moved away, yes, but only went up to a new week opening gap just to find resistance and went lower and returned back to that current week's new week opening gap during the week of March 5th, 2023. Here, aggressive movement away. That means we're going to be trending. And look how much we trended away from that new week opening gap. Now, contrast that with looking at a larger fractal of that price action. This is an hourly chart now. Here's that same new week opening gap and that movement away. Look how much price movement we've seen move away using this concept. So it's allowing you to have a X-ray view behind price. What is it likely to do? If we're seeing it showing willingness to sharply move away from the current new week opening gap, then it's likely that we're entering a trending model. That means the market can move longer and more magnitude behind the price moves instead of a small little scalpers consolidation market. Consolidation signatures with new week opening gap. And obviously I just mentioned how I like to look for a willingness to sharply move away above or below a new week opening gap, that current new week opening gap. So whatever the weekly open separation between Sunday's open and previous week's Friday's close of the current week or the week to come, okay, that's always going to be referred to as current new week opening gap. If price has a unwillingness to move away and just keeps coming right back to that current new week opening gap, then we're probably going to be range bound and consolidating. So you have to be a scalper. You got to be a little bit more nimble in your trades and not expect to be trending. If you look at this example here, another characteristic of a consolidation market is when there's a multitude of new week opening gaps converging within that range. You can see here, this is a new week opening gap high, this is a new week opening gap low, this is a new week opening gap high, and this is a new week opening gap low. I did not draw another one to show the difference between this closing price on this candle and this opening price here. I used a rectangle to shade it. So that way you can see the separations between the three new week opening gaps that's actually being shown here in this price action. So the new week opening gap for this amount of data for this particular week in history, during the week of April, the new week opening gap would be this closing price here on that Friday, and then the opening price down here on Sunday. So that shaded blue area here, that represents this amount of data that's shown on the entire chart here. That would be the new week opening gap for that week, or will be considered the current new week opening gap during this week in history. It's not the present one right now, because we're in May, but I'm showing you in the past how when there is a convergence of multiple new week opening gaps in close proximity to one another, the markets will tend to enter into this range-bound environment. So it helps me as an analyst and as a mentor teach my students and kind of point out in advance we're going to be likely to range-bound. It's not going to be a big moving market. It's going to be range-bound. So you have to be a scalper. Now, that's not to say that there isn't significant price moves in this consolidation. It just means that we're not looking for one-sidedness that lasts for days and weeks. We're looking for highs and lows to be violated and pull back into the middle, which is what? That blue shaded area. Every decline keeps drawing right back inside of that blue current new week opening gap. Every rally above it keeps seeing it come right back down into it. Expand above to take out the buy side here. Where does it go? Right back down into that blue shaded area. If it goes beyond that, where's it going to go? It's going to go down below inside of the old new week opening gap that's in close proximity to the other two. So it's important to have them kept on your chart and keep one chart that's separate as a template. Label it as new week opening gap, and that way you can constantly refer back to where we are in terms of these like magnets on price action. Now, by themselves, you don't just simply look at them and say, okay, price is going to go there. You have to incorporate other factors that I've taught on this channel and during the core content or what I've taught in the 2022 mentorship model. But all of these factors blended together gives you a better understanding of where price is likely to draw to. Not just simply an old high or an old low, but incorporate these old new week opening gaps or the current new week opening gap, because the price will absolutely treat them as a magnet and go back to them, retest them, and then maybe many times spring away to offer you a short-term scalp or maybe even a trending model. Navigating price with new week opening gap. All right, so you can see here, this is actually a current fractal in price action. This is showing the Friday non-farm payroll for May 5th, 2023. You can see here we have an old low where sell side would be residing, and then an old low here where sell side would be residing. The market trades down below both of them. We also traded down into an area that would be considered a fair value gap on the daily chart. I also mentioned it during commentary during Twitter, going into non-farm payroll, ahead of it actually. And then the market gyrates and gravitates around this new week opening gap from March 3rd. Now think about it. We're in May, the 5th day of May 2023, and using levels from March 3rd and March 5th, just those two prices, the Friday's closing price and the Sunday's opening price after. So we're extending that throughout time. Look at the sensitivity here. Look at the closing price on that candle. Look at the low on that candle. Look at the bodies of the candles in here. Look how it's respecting it in here. Look how all the bodies are just stacking above the high of that old new week opening gap from March 3rd of 2023. Then we move higher, come back down in. We have a non-farm payroll event. Price rallies and gravitates to what? This new week opening gap, which is the closest one in proximity. Then it reaches for the other above it. It trades to that, comes back down in, fills that fair value gap, and expands away, reaching into the consequent encroachment of this wick and revisiting back into this civvy here. So there's a buy side above that. We'll see if it wants to reach above that nonetheless, but you can see how price wants to move to these levels as a magnet. They could be mile markers or they could be ultimate targets. Mile markers meaning that it's just reaching for that one initially, and let's see if it can reach to the next one. In your notes, I want you to write down that if we have a new week opening gap and it's likely to go higher, between the two of them, halfway point, if price can reach that far, probabilities are that it will probably reach to the next new week opening gap in the series of the last several weeks and months of new week opening gaps that you would keep on your chart. Looking at it closer, here's a 50-minute time frame. Fair value gap in here, laid over that same March 3rd, 2023 and March 5th, 2023 new week opening gap. Now you're wondering probably, why am I using this one? Well, this happens to be the new week opening gap that runs through all of this data. So in your notes, you want to look at if you're seeing price in consolidations, or if you look at a cluster of price action, go back through time and see what new week opening gap extends through that area. Which brings you to the question, how many new week opening gaps do I use in my charts? Whatever today is, in trading, I look back 60 days. Now, for those that have gone through my core content, you know in month 5, which is a lot of content and a lot of material, and most people that are coming under my wing as a developing student with my knowledge and concepts, they usually tap out during that month because it's pretty intense. And there's a concept that I teach, the IPTA data range, and it's the 60-day look back and the 60-day cast forward. So whatever today is, I look back 60 days, and whatever new week opening gaps have formed in the last 60 days, that's how far I'll look back, and that's the maximum I have on my charts. But I counsel you in the first part during this mentorship in 2023 on my YouTube channel that you want to have at least 5, because that kind of gives you, right now, the ones that are most salient as a new developing student. As you improve and you consider more information and more data, you want to look back using that 60-day look back period that I used for IPTA data ranges. As I mentioned when I taught the content to my paid students, many of them discounted it like it was of no concern. There was no reason for them to even worry about it. It made no sense to them. But obviously, with more information being presented and ongoing education, you can see how those 60 days look back is a major impact to my analysis of what I'm using, how much data am I using, which PD array am I going to consider still valid, all those things. A fair value gap, for instance, if you go back 60 days, a fair value gap 60 days to me is still valid. And it's still valid even if it's already been filled in. So I'm not the average person out there that could see an imbalance in price, and once it trades back up and quote unquote fills it in, they're done with that. I'm not. The algorithm's not done with it either. It's going to refer back to it and respect that same old level because of the time aspect that's incorporated in algorithmic price delivery.